Hi everyone. Welcome back to English Fab, where learning English is practical, useful, and fab. Today's topic is interest rates, something that many learners find confusing. People often wonder why interest rates change, who decides them, and how they affect everyday life, from loans and mortgages to saving money. It can feel overwhelming, but once you break it down, the ideas become much clearer. In this lesson, we'll go through a natural conversation to show how people actually talk about interest rates in daily life. Then, we'll highlight key phrases you can use, explain useful vocabulary in simple terms, and share practical tips to help you confidently discuss money and finance in English. Okay, let's get started. Ben, I keep hearing about interest rates going up. Why is everyone so concerned about it?
Good question. Interest rates are basically the cost of borrowing money.
So if I borrow money from the bank, I have to pay interest.
Exactly. The bank charges you a percentage of the loan amount, and that's the interest rate.
Okay, that makes sense. But who decides what the interest rate should be?
In most countries, the central bank sets a benchmark interest rate. In the US, for example, it's the Federal Reserve.
Oh, so when they raise rates, does everything get more expensive?
Kind of. When rates go up, loans, mortgages, and credit cards all become more expensive because you have to pay more interest.
Yikes. That doesn't sound good for people borrowing money.
True, but higher rates also encourage people to save money because savings accounts and bonds usually pay more interest when rates are high.
Oh, so it has two sides, bad for borrowing, but good for saving.
Exactly. That's why interest rates are such a powerful tool for managing the economy.
How so?
If inflation is high, meaning prices are rising too fast, the central bank may raise interest rates to slow things down.
Because people borrow less and spend less?
Right. And if the economy is too slow, the central bank might lower interest rates to encourage borrowing and spending.
That's actually pretty smart. But how does this affect everyday people like us?
Well, think about mortgages. If you buy a house when rates are low, your monthly payment is cheaper. If rates rise, the same house costs more each month.
Wow, so timing really matters.
Definitely. The same goes for car loans, student loans, and even business loans.
What about the stock market? Does it react to interest rates too?
Absolutely. When rates go up, borrowing costs for companies increase, which can hurt profits. That often makes stock prices fall.
Oh, so investors pay attention to interest rate changes too.
Yes, very closely. Interest rates can influence almost every part of the economy.
I see. But what about people who already have fixed loans, like a fixed-rate mortgage?
If your loan is fixed, you don't feel the change right away. But if you have a variable rate loan, your payments can increase when rates go up.
That could be tough for families.
Exactly. That's why interest rate changes are always big news. They affect millions of people.
So let me sum this up. Higher rates mean more expensive borrowing but better savings, and lower rates mean cheaper borrowing but less incentive to save.
Perfect summary.
Thanks, Ben. I think I finally understand why interest rates are such a big deal.
Anytime, just remember, they may sound boring, but interest rates shape how we live, spend, and save.
And that's it for today's lesson on this topic. Let's quickly review what we covered today. What we talked about: interest rates as the cost of borrowing money, effects of rising and falling rates on people, how interest rates influence the economy and markets. Key phrases: interest rates are basically the cost of borrowing money. The bank charges you a percentage of the loan amount, and that's the interest rate. The central bank sets a benchmark interest rate. When rates go up, loans, mortgages, and credit cards all become more expensive. Higher rates also encourage people to save money. If you buy a house when rates are low, your monthly payment is cheaper. If rates rise, the same house costs more each month. These phrases are useful because they allow you to confidently join conversations about money, banking, and the economy. The more you practice them, the easier it will become to talk about financial topics in English. Try using them when discussing news articles, classroom topics, or even personal situations like loans or savings. Every step you take strengthens both your English skills and your confidence. Okay, thanks for watching today's lesson on English Fab. I hope you found these English tips useful and feel more confident. Remember, practice makes perfect, so try using these phrases in your daily conversations. If you enjoyed this video, don't forget to give it a thumbs up, share it with your friends, and subscribe for more Fab English lessons. Until next time, keep practicing and stay Fab.